services and Asian Paints that are likely to perhaps open in the red?
Okay, Priya Misra is Global Head of Rate Strategy at TD Securities. She's joining us now to take some questions. Priya, great to have you with us here. Thank you very much. What is the cue from the rates market, in your opinion, Priya, in the US? So this week, I think we've seen a 20 basis point rise in the 10-year in the US. But I mean, far away from the highs of the year. Are we going to see a definitive kind of a move, and what's the cue for other asset classes like equities?
Sure. So thanks for having me on. I think there are two-sided risks that we saw really through the month of November, early December. Interest rates in the US, particularly in the long end, declined. I think that the concern was one of recession. So, with the Fed having raised 400 and almost 50 basis points this year, I think the concern was that they've overdone it. And so we've seen interest rates decline. A lot more Fed interest rate cuts have been priced into the yield curve in 2024. I think that's the market saying that things are going to slow down this year. Inflation's going to go down, and that's going to allow the Fed to actually start to cut rates. So I think it was all recession fears. Now, as you talked about, this week we've had a big increase in interest rates. I think that's actually driven by what the ECB did at the end of last week, which was to be more hawkish, to announce the start of quantitative tightening. And then you had the BOJ with a surprise announcement on Monday night, which was essentially widening their yield curve control band. So, U.S. interest rates, I think, are driven by the fact that you've got, the Fed that's still very hawkish. I actually think the market's underpricing how much the Fed will have to hike. I don't think inflation's going to come down that fast. So I think we've still got a little bit of a surprise in terms of how much the Fed might have to hike. But then I think the big tug of war is, what about recession? At what point does the Fed have to reverse course? So you talk about other asset classes. I think they're watching the same macro fundamentals, which is, when does the economy slow down? The economy is actually very strong right now, but when does it slow down? And then when can the Fed respond? And what I'm just concerned about is I think the market's used to having the Fed respond at the first sign of any slowdown. And I think this time around, they're going to be very slow to respond, because inflation, I think, is just going to be very sticky on the way down. It's service driven, it's wage inflation. All that tends to be a lot more slow moving rather than goods inflation. So I think that's going to be the big question for next year.
Okay. Priya, hi, good morning. How are you reading into the China COVID situation? Although it may not be such a big health issue outside of China, the worry is that it may put roadblocks in the form of, say, manufacturing, supply chain, travel, and that may eventually result in slower growth globally. Is that your concern as well?
It is. I think our view has been for a while that, the US might actually be the strongest economy. Global growth is slowing. I think China COVID easing, our view was it was going to be a little more gradual easing. They've opened it up much faster than I think what anyone was looking for. And does that result in a health issue, which actually ends up backfiring? I think what I'm watching for is, on the supply chain front, as you highlighted, if there's an increase in supply chain constraints, that's going to put upward pressure on inflation, make the Fed go more, as well as other central banks go higher. Also, I'm watching for, is there any fiscal stimulus? Particularly from China, that could actually offset some of the growth slowdown. So, but right now, without any signs of fiscal stimulus, I would say it's negative for growth. It's a stagflationary shock. It would be negative for growth, and it could potentially put upward pressure on inflation. But there is an upside risk in case you see the Chinese authorities starting to put some fiscal stimulus in place, maybe targeted, but something around the property sector, or just helping around the health issues. That could potentially put a floor on how bad things could get. But I am concerned about the growth implications, and the consumer might actually pull back significantly in China.
Priya, you said the markets are underpricing the amount of rate hikes the Fed is likely to do next year. What is your base case scenario? How much more by way of rate hikes from the Fed?
Sure. So we're looking for 5.5 as the end point of the hiking cycle. The market's pricing in about 4.9 is being priced in. The Fed themselves talked about 5.25. So why are we higher than that? And I would say the risks are even higher than 5.5 is really the pace of decline in inflation. I think we've gotten that low-hanging fruit in terms of the decline in inflation that we've seen. It's been supply chain led, it's been food, energy, but really we need service inflation. The US consumption basket, 75% of that is services. We need the service inflation to come down, and that I think is going to be sticky because wages are very high. And that's why if you see Chair Powell particularly brought up service inflation, brought up wage inflation, and the labor market is still very tight in the US. So we really need to see those wages downshift to a 3%, 3.5% level. They're running up over 5% before I think service inflation can come down, and then the Fed can stop. So we think they still have another 4, 5 more meetings. They can downshift the pace. We do think they're going to now hike at 25, maybe 50 basis point level. So go slower than the 75 they had been hiking this year. But I think continue hiking until they see inflation, sustaining around 2.5% to 3%.
Priya, any sense on whether what happens in the US, and if your view plays out, I'm assuming the dollar will be weaker, right? Is that the sense?
Yes, through the course of the year, we actually see weakening in the dollar. Right now, we see it a little bit more range bound.
Okay, no. So if the dollar is weaker broadly, I mean that's the bigger trend. The general understanding is, and we've spoken with more others, the sell side as well, out of the US, that it's good news for emerging market flows into emerging markets. Any thoughts?
Yeah, I think once the Fed stops hiking, they potentially start to ease. I think at that point, real interest rates in the US should start to come down. And then I do think you're going to see flows into emerging market. Do we see broad-based flows? I think investors are going to be more discerning. In general, I would say when cost of capital goes up, discipline comes back. And so I think, it may not be something that helps every emerging market. I think there'll be a lot more differentiation in terms of, which emerging market economies are doing well. I think China is going to struggle on that front because I don't see their growth picture. Other parts of EMs I think can outperform. But yeah, I think the flows into emerging markets should start to increase through the course of 2023. I don't see it in the first half. I see it more in the second half when the Fed starts to ease.
Okay, well, in case we don't see you again before the new year, which in all likelihood we won't, considering there are just a few days left, Happy New Year to you in advance and to your entire team. Thanks a lot for joining in, and wishing everyone at TD Securities a great year ahead.
Thank you.
Okay, well, that's a word coming in on the macro situation, but let's do a quick break now. On the other side, our list of top 10 stocks and many important discussions coming up with some experts in just a bit. Stay tuned.